Okay, so thank you guys for joining. This is one of a multi-part series. If you've noticed, we've done this last year. I'm going to try to do this a little bit different than last year. I'm going to try to do it different every time for a couple reasons, just based on tweaks and feedback from the way we've done it last time. This is a series to teach you guys how to build a financial model. So it's all about modeling. I'm going to drop a little bit more of the conceptual side, and let's see. Let's tweak as we go. If people want more of the concepts, let me know. I appreciate the feedback. I appreciate you guys telling as many people as you can about this, because the more people that get gathered together, the more feedback we get, and the more we can tweak these series. Ultimately, I would love to have this kind of mimic what we do in our school, which is literally 152 hours of 1 or 2 hour sessions, all about how to be an analyst. But right now, what we're just doing is we're going to simulate what you would get in a standard crash course at a like a 2-day to 5-day crash course. We're going to do it in sequential order, in 1 to 2 hour increments in the mornings. My perspective is you learn a lot better when doing this in an hour, reviewing the video, practicing at home, and then coming back to the next part, as opposed to a full 5 or 6 hour day. So I'm downloading this and recording this. You can upload it. I'm going to put this up and send this to everybody after the class with a link to the model, and I'll continue to do that as we learn. We're going to go through today building a complete financial statement in 6 major components. I'm going to show you right now. Oh, I don't have it opened. I'm just going to take the screen off so I can open it real quick. The 6 major components. Excuse my silence for a second as I pull up the file that I had posted. You know what? I could probably just download it like everybody else is. Here it is. The 6 components are the income statement, cash flow statement, balance sheet, and then 3 supporting schedules that enable the flow and continuity of the first 3: depreciation schedule, working capital schedule, and debt schedule. So I want to introduce this, and I want to get right into the modeling. What I do want to mention is the series of books that I have that go through the modeling in complete detail. So detail that we're going to scratch the surface in the first 2 series. If people continue to join and appreciate the series and want more in depth, I'll go more in depth. If people want more concepts, I'll go in concepts. So our first 3 books, so the book on the left is a new one that's going to be out at the end of the year. The first 3 books are all about financial modeling evaluation, which is what we're going to go through today. And the next course is building a full model from scratch. How do you value a company? DCF. Second book is mergers and acquisitions, how to build an accretion dilution analysis, full merger model. And then leverage buyouts, how to build and construct a leverage buyout model. And all the bells and whistles that would go into a fully linked leverage buyout analysis. In addition to what you would learn here, the books give you a lot more detail. They also go through how to not only build the model and the projections like what we're going to go through today, but more how do you open up an annual report on a real company, flip through the report, and be able to extract historical information and lay out historical information as a good analyst would. It also goes through concepts, what things mean. So we're kind of just going to go through, this is really more, again, simulating a crash course, how do you link a model together. In the next level, we'll get into the detail that the books handle. The new book on the left precedes the first 3. The new book is actually just straight up interviews, questions and answers in sequential order from the most basic to very, very technical, all the way to paper cases. If I give you EBITDA and a few assumptions, how do you put together and write out on paper a merger and acquisition analysis, or a leverage buyout analysis, or a DCF valuation? It's a workbook. It's question and answer. It gives you practice interviews, question after question, with empty spaces so you can kind of fill in and check your answers. It's really, if you want to cut to the chase and go through the technical pieces in terms of learning what they might ask you in an interview and honing in on that. Looks like my PowerPoint is crashing. Great. I'm not surprised. This is the guide. So would love your feedback on that. If you recall at the beginning of the month, or actually it was last month now, I had done a quick technical interview overview about how to break into investment banking. This is an extension of that. Okay. So as promised, what this modeling course is about is modeling. So let's get into that. So hopefully you guys can download the model and work with the Excel as I'm working with the Excel. or if you choose to just watch and then watch the recording again and try to practice this, you can do it that way. So what I want to do is I want to focus on the income statement today, and let's see if we have time, we can kind of go into the cash flow statement and talk about how it's supporting. But the income statement, as you know, measures profitability, right? Starts with revenue. It goes from revenue all the way down to net income. So revenue is often driven by a combination of price and volume. So again, I want to kind of cut to just the modeling aspect. If you see, the revenue here is generated by a product that's producing 500, let's say, widgets. This is a fictitious company. And those widgets have a price of $20 per widget. So the revenue is a product of the two. Okay? The revenue is the volume times the pricing. Okay? So if you go into cell D12 and hit equals and link up to the price, use the asterisk to multiply and link up to the volume, hit enter. You can then copy, this is the revenue. You can then copy this to the right, but I would only copy this to the right for the historical numbers. I wouldn't copy to the right all the way through. There's a couple ways to copy things to the right. You can click and drag, which means just taking your mouse and going to the bottom right corner, clicking the button, of course, and dragging out to 2011. Another way to do this is the Control-R method. So I want you guys to be as efficient with hotkeys as possible. The Control-R method is first you want to highlight using the arrow keys. You want to get to the cell that you want to be copied over, which is cell D11. Hold down the Shift button. While holding down the Shift button, tapping the right arrow twice, letting go of the Shift button, and then tap Control-R. Control-R is synonymous with copyright. Think copyright. Okay. Just another side note, the modeling, the course, the books, all have an interview prep spin. For those that are looking to kind of get into the investment banking industry, we go through a lot of questions that would be asked in an interview. So if we have a big attendance, we have a good attendance now, if we continue to have good attendance throughout the modeling crash course, I want to go and do a deeper level. I want to go and say, okay, now that you've learned how to build a model, what are some important interview questions that come out of this? How would you be asked this in an interview? And let's practice some interview questions. And then I want to go into maybe a deeper level of modeling where, like what we do in the first book with Walmart, let's pull up an annual report and let's lay out hard-coded numbers and then link them in with a little bit of a deeper eye, right? With an eye of, okay, how would you do this as an analyst in Wall Street? How would you think about this number, something that's not standard? So let's just go through the first cut analysis. Here we need to make projections, right? So price and volume are driven by growth. The growth that's been assumed here is 0 for pricing, meaning we're not going to adjust the pricing. 10% for volume, meaning we're going to assume that the volume goes up by 10%. So let's say if the volume is going to go up by 10%, how do we create a formula that allows our volume growth to be 10%? In other words, let's have G9. We'll hit equal. We'll have G9 grow 10% off of 2011. So G9 is going to be equal to, tap over to the year before, volume, hit multiply, open parentheses, times 1 plus, link to the 10%, close parentheses. So I'm sure everybody here is at different paces. I'm going to try to adjust the pace accordingly, but there's a lot of people on. If this is going a little fast for you, again, I recommend, this is why I'm recording it. You'll have time to practice before the next session. If it's going a little slow, we will start to speed up as you guys get more comfortable with the basics of the Excel cells. I'm going to hit enter. Copy everything to the right. Okay, so again, the copy right means select the cell that you want to be copied across while holding down Shift and tapping the right arrow. Highlight everything that you want to be copied, the cells that you want to be copied into. Let go, Control-R. Okay. We can also do the same thing above here. Even though 0% growth means there's not going to be a change, we still want the formula in here so our model can be flexible enough to handle a potential price increase. So we're going to hit equals, arrow down to the 0%, multiply, open parentheses, 1 plus the cell before, close parentheses, and copy to the right. So I went a little faster that time. I'm going to also take F11, copy that to the right. Now, you might have noticed I copied to the right, but the cells didn't update. You have to hit F. Uh-oh. Why is it not recalculating? Oh, I know why it's not recalculating. Look at that. Why are we not recalculating here? I did this backwards. I'm sorry, everybody. This is supposed to be, I did G8 times 1 plus F7. This should be F8 times 1. I'm sorry. 5 minutes in and I'm making mistakes. That's embarrassing. This is F7 times 1 plus G8. What I was saying, there you go. I should have picked up on that before. Okay. Tough. It's a Saturday morning. That's going to be my excuse for you guys. What I was going to say is sometimes you'll see that your cells aren't updating and recalculating, and if that's the case, that means your model is set to manual calculation. I thought maybe this Excel model was set to manual calculation. When we have everything linked through, I'm going to show you setting your models to manual and automatic calculation for circular references. You would have to hit F9 then to tell the model to recalculate. I had assumed maybe the numbers weren't updating, but no, I'd given you the wrong instructions, and I had given you a bad formula, and that is my mistake. Okay. Now, cost of goods sold. After revenue, you have various costs that are used to reduce revenue for tax purposes, and that build towards net income. So the first major cost is cost of goods sold. Cost of goods sold are the costs most directly related to your revenue production. And for that reason, we often look at cost of goods sold as a percentage of revenue. So let's do that. Cost of goods sold is often driven as a percentage of revenue. So we will calculate cost of goods sold as a percentage of revenue to give us and to help us analyze an assumption to make projections. So we're going to look at the cost of goods sold. We're going to do equals cost of goods sold divided by revenue. That's going to give us a percentage. You're going to want to copy that to the right. Only 2 cells out. You don't want to copy this further because in 2012 we want to use this percentage as a driver for future assumptions. Okay? So once you have 25%, now we're going to say we're going to use this to analyze, okay, what will their cost of goods sold be in the future? I don't know. We don't have a number that's given. But what we do know is it's consistently been 25%. Their costs have consistently been 25% of revenue. So it's a safe assumption to make to assume that that their cost of goods sold will be 25% of revenue in the future. So we're going to hard code 25%. Now notice what we've done up here, and it's been pre-colored for you. Notice the coloring. The coloring is very important. Any number that's hard coded or an assumption driver should be in blue font, whereas any other formula should be in black font. The reason why that's important is when you have a model that's complete, and you're building a model maybe for an associate, for a superior, or you're passing your model on to somebody else, they're going to want to know right away what is driving the model. What are the assumption drivers, and what are the hard-coded numbers that are driving the model? And those are the blue numbers. If it's colored appropriately, it's easier to see. Otherwise, you have to go in and say, okay, well, what are the assumptions driving your model? You have to go in and look at each number and say, okay, what are the numbers driving your model? Just by hitting F2, I hit F1, and then this annoying help box came up. By hitting F2, they want to look at, okay, well, here's a formula and here's a hard code. If it wasn't colored appropriately, they'd have to dig in cell by cell using F2. But if you've colored it for them, you've effectively made it easier. Close all these windows. Okay. So the 25% should be colored in blue font. Okay. Oops. That was a highlight. Okay. And then we want to back into, now that we've made 25% our assumption, we're going to say, okay, well, what does that mean for assumed cost of goods sold? Let's take the revenue and let's multiply it by 25%. And we can copy both of these to the right. So notice, and I don't want my cost of goods sold to be bold. You could want it to be bold. I don't want it to be bold. Now notice the difference between historical numbers and making projections. In the historical numbers, obviously the values were given. This is a fictitious company, but in a real company, you'll see in the books, and if we get into deeper analyses, in a real company, they give you, obviously, the reported numbers. We want to use those reported numbers to calculate metrics that will give us indicators to determine how we might want to project our values. So we use these historical numbers to look at metrics. We analyzed percentage of revenue as a metric. The projections are based off of metrics that we've analyzed and hard-coded. So we've analyzed 25%, and we said, okay, that is our driver. So we hard-coded 25% and used that to project our own future cost of goods sold value. A lot of people get confused by that. I see a lot of people, maybe for whatever reason, they're confused about, maybe they accidentally copied this number to the right. And look what I did here. I copied this number to the right. And that's a mistake. Although it looks okay now, what you've basically done is, here, look what you've done. We have cost of goods sold as a percentage of revenue being built off of the cost of goods sold projection. Yet we have this cost of goods sold projection being built off of the percentage of revenue. It's one being built off another. You have one value dependent upon another. And although it's working right now, you're basically creating a circular reference that will cause problems in the future. I did just mention circular references. There is going to be one intentional circular reference that you'll want, not this one. So I'm going to undo the mistake that I just made. I mean, it was an intentional mistake. Okay? And then we can calculate gross profit, revenue minus cost of goods sold. We can copy this to the right. We also then want to link in another metric, gross profit margin. This is a metric for analysis that a lot of people want to see. Gross profit margin is the gross profit divided by revenue. We can copy this to the right. Okay? Guys, this is a good time to save your model. I'm going to go to File. I'm going to go to Save As. Okay? I'm going to go, I'm going to put this on my desktop, let's say, for now. Okay? I'm going to say Practice Template, 1029. Okay, take out the webinar. Save your own as well. Some of you guys have met me, some of you guys haven't. Just a side note, I spent a couple of years at JP Morgan and then moved on to Morgan Stanley as an analyst. I recommend you watch our interview preparation webinar if you want an overview of a deep overview of what we do. But I was an analyst at Morgan Stanley, and then I went over to the buy side to T.H. Lee and did private equity. At Morgan Stanley did banking, of course, and then founded the school, the New York School of Finance, where we teach students modeling, but we do it on a semester basis, right? We have students come in. The goal is to bridge the gap between those that study business or maybe want to study business and just had a tough time getting into private equity, and we've had over 700 students with a 90% success rate. It is a success rate that's been quantified per student into banking-related fields, which we're very excited about. And the way we do that is we go through this 154 hours of instruction in the morning, and then we put you guys into internships on Wall Street. So if anybody's interested, send me an email. Let me know. So despite my little mistakes that I'm making, and I'll hopefully make as few as possible, but I like to think I am qualified. So here are some other expenses. After your first tier of expenses, cost of goods sold, as I mentioned, are the costs most directly related to the units being produced. There is a second tier of expenses that are, let's say, slightly indirectly related to the revenue, but are necessary for the operations of the business. Expenses like salaries, overhead, rent. We call those expenses selling, general, and administrative expenses. Research and development. Other types, advertising, marketing, all expenses necessary for the operations of your business. Again, expenses, I don't want to say again, I didn't talk about this, expenses can be fixed, expenses can be variable. So again, I'm not going to talk too much about the concepts. I assume most people just want to learn, learn the modeling. But I will say this, expenses that are fixed are more like, let's say, office rents. Right? Office rents, which year over year, maybe they'll increase 5%, but they won't increase significantly. Those are fixed expenses. The variable expenses are expenses that will increase or decrease in line with the revenue that's being produced in the business. So as revenue grows, these variable expenses will grow. So an example of an expense that's almost always variable is cost of goods sold, because cost of goods sold are directly related to the products being produced. If you produce and sell more products, your revenue will go up, your cost of goods sold is going to go up. If you produce and sell less products, your revenue is going to go down, your cost of goods sold will go down. SG&A is often, rents, the example I gave you, is often not based on revenue, but just might increase 5% a year. If that's the case, then you would not project your rents based on revenue. You'd project your rents based on year-over-year growth, 5%. We did this based on year-over-year growth. We assumed volume would increase at 10%. So this is how you would do year-over-year growth. Despite what I'm saying, though, for most large, let's say Fortune 500 companies, because these expenses are so big, they usually all fall in line with revenue. Now, you said, well, I just gave you the example of office rent and that grows 5%. Well, office rent might be in here too. But I mean, just the amalgamated, all the major expenses that go into this big SG&A line, even though some little identifiable lines within this subset might be based on year-over-year growth, usually what I've seen is these big major line items are also projected based on percentage of revenue. And if you're not sure, prove it to yourself. Prove it to yourself by calculating this over the past few years as a percentage of revenue and see what that means for a percentage of revenue. If the percentage of revenue year over year falls in line, when I say falls in line, means it's 35%, 36%, 35%, then you know what? Looking at this cost as a percentage of revenue is probably a good way to project it. If, however, it's all over the place, it's 20% one year, 15% the other year, 40% the other, then maybe looking at this as a percentage of revenue is not the right way to look at this expense. Maybe it's better tracked as a percentage of growth. But almost always when modeling out big companies do I see these operating expense line items as a percentage of revenue. Let's look at it as a percentage of revenue. So we're going to take the 900, so in cell D20, we're going to go to D19 divided by revenue. Okay? And we're going to copy it to the right only 2 times because we're going to use this 9% for our projections. It's consistent here. Do the same thing with SG&A. Equal to SG&A as a percentage of revenue divided by revenue. It's good practice for you guys. Good Excel practice. Copy to the right twice. Also good practice to make projections. So let's assume 9%. I'm going to hard code 9%. Side note, instead of hard coding, you can also do equals to the year before. Some people like to do that. I might recommend that. However, if you do that, you might get slightly different numbers than I'm getting. Why? Because, I'm going to hard code 9%, meaning 9.0000%. If you do equal to the year before, this might not actually be 9%. Actually, what is it? I can tell you exactly what it is. This is actually 8.677769. So just for purposes of the modeling and to make sure we're matching numbers together, let's hard code in 9%. And I'm going to back into this by doing equal in cell G19. I'm going to do equal G20 times revenue. Copy to the right. I'm going to do the same down here, 13%. Equal to, that 13% times revenue. Guys, if this is going too fast, I'm going to upload this and you're going to have all weekend. Catch up. Okay, other. Let's just assume this is 0 for now. Okay, this is a placeholder for if you want to use this for a real company and expand other line items into however many line items that real company has. Total operating expenses, we want to add these 3 line items together. You do not want to include the percentage, obviously. So we're going to do plus other, plus SG&A, plus research and development, copy to the right. Okay. Other income. Companies might have other income. Okay. Other areas where the book talks about other income. Again, I'm not going to go too deep into the concepts. This is just modeling, but other sources for where the company might generate income. I'm going to copy this to the right. I'm going to keep it 0. If it's 0 historically, I'm going to assume it's 0. And I'm going to calculate EBITDA. EBITDA is gross profit minus OPEX minus other income. So copy this to the right. I'm going to give you a few minutes to catch up. While you're doing that, I'm going to just kind of see if there's any questions here that might be related to the topics that we've discussed. So somebody asked a good question. What if the percentages were different each year? So I'm going to get into a little bit into making projections. So sometimes you might have like 8, 9, 7. In my book, Financial Modeling Evaluation, I could spend a whole class on making projections. I talk about there are 7 ways to project historical line items. You have to research the line item. In a nutshell, you have to research the line item. If you see something like 9, 8, 7, okay, you want to think about, is that a trend? Is that going to be an ongoing trend? Is the 9, 8, 7, it looks like the company, you went from 9% to 8%, 7%, which means the costs are reducing as a percentage of revenue. Does that mean the company is cutting costs? Will it be 6 next year? Or is that too conservative? So, in short, you do have to, if you see the numbers moving around, you have to do some research on what's going on. And when I say do research, I mean Google the company, try to find earnings calls. When the company has an earnings call, try to find the transcripts of those earnings calls. If you work for a firm, you can sign up for their earnings calls and actually listen to the earnings calls to get some clarity in the management projections. You can go on the company website, listen to investor presentations where they might talk about projections. This is where you have to do some research. In the book, I do quantify there are 7 methods of making projections, which I do recommend. But in short, if they're not that consistent, you do have to make the assumptions. Again, the perspective I'm going to have here is, listen, when you're tasked as an analyst on the job, I'm going to be careful because I can go out on telling stories. When you're tasked as an analyst on the job, and somebody says, listen, there's Starbucks. I want to value Starbucks. We're looking at Starbucks, right? And you're tasked to build the model. A lot of times, time management's an issue because a lot of times there's some analysts, some of you guys who might be analysts can get very technical. Some of you guys are very research oriented. And I've seen analysts say, okay, I'm going to download the 10K. I'm going to get smart of the company. I'm going to read about the company. I'm going to spend a couple days doing research, understand what the company's about, and then I'm going to start the model. Well, sometimes you don't have that time, right? Sometimes you're given short deadlines, right? Or sometimes maybe you are given a deadline, like a few days, but the associate comes by and says, oh, I want to see what your work on the model's been. And you say, oh, I haven't done the model yet. I'm still doing research. Yeah, okay, that might not look so good. My recommendation as an analyst is get the numbers in first. Get the mechanics down. Then go back, research the company, and say, okay, well, now I want to kind of get smart of the company to start to hone in on tweaking the assumptions. And you'll have a framework. You have a full model to start with. So that's the perspective I'm going through with these courses. Get the numbers in, get the formulas in, get the mechanics in. If there's some assumptions that are questionable, well, we're going to save that. Once I do some research, then I can say, oh, it looks like the company's cutting costs. Okay, very simple. I'm going to bring this down to 20. You can update your model while you're doing research, as opposed to the other way, when you're doing research, you're jotting down assumptions, and then you're building the model, and then you're going to go back and say, okay, well, the model's results produced something different than I had realized before. Now I got to reread and re-research again with new perspective. Get the numbers in there is my recommendation, and then go back and do your research. Okay. Depreciation, amortization. We will construct this in the scheduled depreciation. So this is something we're going to skip over. And in modeling, I always recommend depreciation you will leave empty. Okay. When we get to the depreciation schedule, we will link that in and continue. But it doesn't mean we still can't link in formulas underneath that. So we can calculate EBIT. EBIT is EBITDA minus depreciation. Okay. Now, I forgot something. Margin, EBITDA margin. Let's link that in. EBITDA margin is EBITDA divided by revenue. Okay. Oh, and look at that. I left out total revenue growth. Okay, we can link that in. Total revenue growth, row 12, is E11 divided by D11 minus 1. These are just tracking numbers. EBIT, we can copy to the right. EBIT margin. The margin is always that value, the value that's defined. So EBIT margin is that by EBIT divided by revenue. Okay, divided by revenue. Go to the top, copy to the right. Interest expense, interest income will be handled in the debt schedule. You will see this pattern. You might think, oh, how do I know what to leave out and what to... In every model that we build, this core model, merger model, LBO model, we always leave out depreciation and interest because there are supporting schedules where we will build accurate values projecting depreciation and interest. Leave this out, and I want to calculate net interest expense. So you might ask, okay, interest income, why is that in parentheses? Well, this is a weird thing about income statements. In an income statement, you have revenue, of course. And then you have expenses designed to reduce your revenue down to net income. For some reason, expenses, this is in the U.S., in other countries I've seen it different, but in the U.S., you have expenses listed as positive numbers. Even though they're reducing, they're listed as positive numbers. It's a convention. So when you get to something like income, that's not going to be reducing your revenue, but increasing your revenue. So as to not confuse, to show and illustrate that it's not an expense, we show it as a negative in parentheses. Even though it's income. I know, it's confusing. So when you say net interest expense, you're actually adding the interest expense plus the interest income, because the interest income is actually reducing your expense. It's reducing your expense. It's increasing your income. Okay? Copy that to the right. If you really wanted to, and I've seen other companies do this, you can show interest income as a positive, but you have to be careful to make sure that when you do net interest expense, it's your interest expense then minus the income. Okay? So income before tax is going to be your EBIT minus your interest. For those that don't know, notice once you get to EBITDA, EBITDA stands for earnings before interest, taxes, depreciation, amortization. We go from EBITDA to E. E is earnings, also known as net income. You go from EBITDA to E by subtracting the components that make up EBITDA. So we're going to subtract D&A to get from EBITDA to EBIT. So here we are. Here we're at EBIT. We're going to now subtract I, interest, to get from EBIT to EBT. The copy is to the right. EBT or IBT, earnings, income. I've tried to define these things differently so you get familiar with the different terminology. Okay? Then we subtract taxes to get from IBT to I, or to E, or to net income. They all mean the same thing. We can calculate the margin by going equals income before tax divided by revenue. Copy to the right. Okay? Now we're at income tax expense. Income tax expense, we want to take a look at historically what percentage of taxes they've been paying. How do we do that? Well, you're paid a percentage of your earnings before tax. So let's calculate that. This equals the income tax expense divided by, right, slash, income before tax. Hit enter, copy to the right. Not all the way though, because again, just like our cost assumptions, we're going to use this 35% to make our projection. We're going to go into 2012. We're going to say, okay, they've paid 35% taxes historically. They're going to pay 35% again. We're going to go equals 35% times 70543. Copy everything to the right. Now you might say, okay, look at this. Why did this jump from 5 to 7? Well, there's a few expenses we don't have in there yet, but because everything is being linked dynamically, once these expenses link in, it'll flow down and this will all change. Okay? Once you have that, let's calculate net income for continuing operations. which is the IBT minus the taxes. Copy to the right. Okay? While you're trying to build to that, let me see if there's a couple more questions I can answer. Okay? Somebody asked why interest income is negative. I just answered that before. Somebody asked, I don't understand. Somebody asked a question, how do you get the numbers in there if there are original research done on the company? I don't understand that question. This is a valid question here. Not that the other questions aren't valid, but somebody asked, and I just kind of answered it, but to reiterate, somebody asked, okay, why is EBITDA, so we have EBITDA as gross profit minus OPEX minus other income. Somebody said, isn't other income, shouldn't it be a plus? If there was a value in here, I would show it as negative 500 to show that this is income. So when I have minus other income, it's minus the minus, this is increasing. So as I mentioned before, and okay, just to answer the question somebody else asked, why is interest income in negative parentheses? I have seen most often, because expenses are shown as a positive number, income items are shown as a negative, so as to not confuse, so as to not have people think, oh, that's another expense. If you really want to show income as positive, fine, but then you have to be careful to put pluses in here. To me, it's just a lot smoother to continue with the logic of if the expenses are positive, then income is negative, and then you're always subtracting down. You're always minus, minus, minus. You don't have to be concerned about, well, is this minus or is this plus? Or it's always minus, minus, minus. Okay, good questions. Somebody asked for a formula in G19. I'm sorry if I missed that earlier. G19 is G11 times G20. D&A is not added back into EBITDA. D&A is subtracted from EBITDA to get to EBIT. Okay. 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 And then non-occurring events. So non-occurring events are one-time events. Examples of non-occurring events are like a sale of property, gain or loss on a sale, happens once. You don't have any here. Let's copy this to the right. Somebody asked, how do you copy to the right again? I'm going to hold down Shift. You want to first highlight the cell that you want copied over. While holding down Shift, tap the right arrow to include the cells that you want to be copied into. Let go. Control R. Control R is copyright. Control R everything. I'm going to add up the non-occurring events. One way to quickly add a series of columns or rows, Alt equals. Alt equals. Hold down Alt, type equals, hit Enter. Alt equals is a quick sum formula. Alt equals, copy to the right. So play around with that. Okay. Next. Income attributable to minority interests. These are investors that hold a minority, or now they call it non-controlling interest, stake in the company. If they have 5%, they get 5% of the net income, for example. So this is 0 here. But just to illustrate how it works, I want to put, like, let's say 500. You don't have to type 500 with me. Well, let's do this. Let me put the formula in, and then I'm going to show you how it works. So if somebody, right now it's 0, but if somebody had a value in there, meaning there was a non-controlling or minority interest investor that had a stake, we'd want to figure out what percentage of net income has been paid out so we can make our projections. If somebody's been paying out 5% of net income, then we need to, in the future, project that we have to pay out 5% of net income, okay? So I'm going to do equals that income attributable to minority interest divided by the net income. Now I realized I didn't calculate net income. So here we go. So let me just do that. I'm sorry. The net income here is the net income from continuing operations minus the non-recurring events. Okay? Now we can move forward. The net income from continuing operations minus non-recurring events. Income attributable to minority interests. We're going to say, okay, how much did they pay? Here it's 0, but if they had paid, how much did they pay? Divided by net income. That will give me the percentage paid out. So it's 0 here. And keep it. But if it was like 500, I know they're paying 16%. I'm going to keep it 0. But just so you have the formula, I'm going to copy this to the right twice. Okay? And if it was like 16%, just like any cost, I'd hard code 16%. Now I'm going to hard code 0 because it was 0. And I'd want to back into it. I back into it by taking the net income times the percent. And you can copy this to the right. Okay? There's D39. And minority interest, also known as non-controlling interest, is a stake that a non-controlling investor has in the company, and this company would have to pay that person a percentage of net income a year, for example. 5%, 6%, for example. Okay. Now we have dividends. Dividends paid. Okay. How do you think about dividends paid? Well, the dividends paid are paid per share. Okay. So we're going to multiply. Right? If the company is paying 8 cents to every shareholder, you're going to take 8 cents and multiply it by the number of shareholders out there. You use the basic shares. So let me talk about a couple things here. I want to talk about basic versus diluted shares. And I want to talk about the units here. Okay, so first of all, there's a difference between basic shares and diluted shares. The basic shares are the shares outstanding in the market trading right now. That's the basic number of shares. The diluted shares, I like to think of as like a what-if scenario. Right? There are other types of holders out there. There are option holders. There are people that hold employee stock options or tradable options. What are options? Options are a contract demonstrating a right to buy a share. Right? So if somebody has an option, they don't actually have a stock. They have a contract, basically, that says, I can convert this into an option when I want to, and they want to under certain conditions. So in certain situations, somebody might want to know, an investor might want to know, or an acquirer might want to know, how many option holders are out there? Or more importantly, if those option holders decide to convert those contracts into real shares today, right now, how many shares would be in the market? It's like a what-if scenario. That's the diluted share count. The diluted share count says, what would happen if everybody exercises on their options today? How many shares would be out there in the market? It's an important number for certain analyses. We'll talk about those analyses in valuation and M&A. So for now, we don't care about the diluted. We care about the basic, because if you are paying out dividends, you're only going to pay out dividends to the shareholders that are actually out in the market, the basic shares. So you would multiply 8 cents times the 1 million. Now, if you see that, that gives you 80,000, okay? And now, this number is quite big. It's a lot bigger than net income. They can't pay that. Well, that's because the units are off. So what do I mean? So if you look at the top left, you'll see this model is built in thousands units, meaning when I say 10,000, that means 10,000,000. Or actually, that really means 10 million. That's rounded to the thousands units, which is fine. You see that in a lot of financial reports. But this says, and you might see this in financial reports, in thousands except shares and per share amounts. Meaning, even though this whole model is in thousands, the number of shares are reported in actual numbers. Sometimes that's done because a lot of times investors want to see the actual number of shares. They don't want to see rounding number of shares. So even though the model is in thousands, the share count is actual numbers. Okay? So what does that mean? Well, the units are different. So when I start to get into numbers like dividends paid, where I have thousands, where I have an actual number, and I want to put this into thousands, this 80,000 actually means $80,000. It doesn't mean $80 million. I need to convert this into thousands units by dividing by 1,000. So I need to append this formula. So right now where I highlighted it, it says D51 If you go up to the formula bar, click it and add divided by 1,000 to put this back into standard units. This is what they're actually paying, 80,000. If I kept it at 80,000, it would imply they're paying 80 million. You just have to be careful about the units. And now in the future, I'm going to continue to assume the company's paying 8 cents a share. So I'm just going to copy this to the right. Now you notice when you copy this to the right, it's 0 because my share count links haven't been copied to the right. I'm going to also copy this to the right. I'm going to continue to assume that the shares aren't going to change. We can make adjustments to this later in the course when we're raising equity, paying back debt, as long as we have a continued following. So guys, please tell your friends, as long as we have a continued following, I'm going to keep teaching. I'm going to keep doing this. Okay? Now, net income after dividends, non-controlling interest, is just what it says. It's the net income minus non-controlling interest minus dividends. This is the bottom line here. Copy to the right. Okay? Does anybody have questions on this? Somebody has, let me see if I can figure this out, BJ. So you got 32 for E39, okay? If you have 32, you figured it out. Okay. Okay. And then somebody asked percent minority interest. Okay, there you go. Okay, guys? Okay, earnings per share. Now, earnings per share is a very important metric. We'll talk about why in valuation, but earnings per share is the net income being produced by the business divided by the number of shares outstanding. Earnings is the earnings divided by shares. Now, one quick thing before you do that. There are several types of earnings here. There's net income from continuing operations. There's net income after non-recurring events. There's net income after dividends and minority interest. The net income that's usually utilized for earnings per share. And I've seen it done all different ways. But the net income that's used, because some people ask, well, which net income do I use? And again, it's partly your choice. You just pick one and go with it. But oftentimes, most often net income I've seen used is the net income before dividends and minority interests. Why? Because earnings per share is most popular amongst investors. Investors that want to value the stock. Investors that want to say, I might want to invest in this stock, so I want to see what this stock is worth to me. I want to estimate what the stock price might be worth in the future. And we're going to do that together. So if an investor is valuing this and wants to know what the value of the stock is to him, he's going to want to look at the net income before investors have been paid out. This net income is after investors have been paid out. This is the net income minus dividends, minus non-dividends. This is the net income after investors have been paid out. So if you want to look at earnings per share as an investor, you want to look at the net income before investors have been paid out. So we're going to take the net income divided by the basic shares. Notice there's two types of earnings per share. There's basic and there's diluted. The basic earnings per share is based on basic shares. The diluted earnings per share is based on the diluted shares. Now, I'm going to hit enter, but before you hit enter, if it's too late, you can go and edit. You'll notice it says 0. It says 0 because we have a problem, because we have a net income in thousands units, but we have shares again in actual numbers. we have a difference, we have a metric that has two different units. So we need to multiply this by 1,000 so we're apples to apples. And this gives us $3.05. We're going to interpret this in the valuation course. For diluted shares, it's the same net income, okay, before payouts divided by the diluted shares times 1,000. Okay? Copy this to the right. And there you have earnings per share. And guys, I'm going to stop here. Okay? I know, one of the feedbacks that I'd gotten from the last series is it'd be ideal if you can break it up. At this point, I would have gone into the cash flow. So I think, Nick, this is great for you guys to sit with, process. I want to do this every Saturday or every other Saturday. I want to poll you guys. I want to see what you like about it, what you don't like about it, what I can tweak. I want this to be interactive. Let me know what we can adjust. And again, please tell your friends. I'm going to upload this recording, so if people want to jump in later, they can kind of listen to the recording and not feel lost. I really want this to be a valuable tool for you and as many people as possible to incentivize me from an excitement perspective to continue to do it. I can go on and on and on with this stuff. We can get deeper and deeper and deeper. So let me know. I'm going to see if you have any questions right now. Let's see. Okay. Some of you guys are asking about modeling out the diluted shares, things like that. We're going to handle that in valuation. So we'll get deeper. Okay. So guys, I'm going to send out a quick poll a little bit later to see what you think we can improve upon, anything else that you think we should add to these types of things. And the next one is getting to the cash flow. So thank you guys for your time, and we'll talk soon.